Right now, Canada's combined federal and provincial debt is on track to hit $2.3 trillion in the current fiscal year. There's about $56,000 of government debt for every man, woman, and child in this country. And everyone I've talked to in the last 6 months is asking the same questions. At what point does this become unsustainable? So today I want to do something a little bit different. I want to walk through, as honestly as I can, what would actually happen to Canada and our homeowners if our debt situation hit the breaking point. Not a conspiracy version, not a doom prepper version, just math and historical records, and the most realistic outcomes that we could predict. The good, the bad, and of course the honestly brutal. And by the end of this video, you'll know exactly what to look at in your own mortgage and financial situation to protect yourself either way. Now, before we dive in, here's the rules of the video. We're not doing fear-mongering, we're not predicting a crash. We're going to look at 4 things. 1, what a sovereign debt default actually means, because most people actually get it wrong. 2, what has historically happened to homeowners, savers, workers, and the economy of a country that hit the debt wall. 3, what a realistic Canadian version of that scenario could look like. And of course, 4, the 3 defensive moves you can make so that you're protected regardless of which way things plan out. Now, you might be asking why this matters for you right now, even if you think this sounds far-fetched. Well, it's because the way you structure your mortgage today, fixed versus variable, amortization length, whether you locked in with a big bank or a broker who shopped the market, all of those things assume the financial system is roughly the same. And history shows that assumptions don't always hold up. If you understand what happens when it doesn't, you make smarter decisions either way. And that's the goal of this video. Let's start by clearing up what most people get wrong. When people hear Canada defaults, they picture the government just stopping payments and the country collapsing overnight. And that's almost never what happens with developed countries. There are really 3 forms a debt crisis can take on. 1, outright default. The government literally stops paying bondholders. And that's extremely rare for advanced economies because it locks you out of credit markets for a decade or more. 2, restructuring. The government renegotiates the terms of its debt, often forcing bondholders to accept less than they're owed. And this is generally more common. 3, inflation-driven debasement. The government doesn't technically default at all. They just run inflation hot enough that the real value of that debt shrinks over the years. Now, according to the IMF and economists like Cameron Reinhart and Kenneth Rogoff, I'm hoping I'm pronouncing that right, these are the 2 people that literally wrote the book on this. Inflation has been the most common path advanced economies take when their debt load becomes unsustainable. It's politically easier than default. It's gradual enough that most people don't notice it aggressively until it's done. And it's incredibly effective at transferring wealth from lenders to borrowers. That's the version we'd most likely see in Canada. Not a sudden default, but more of a slower grind. Now, the cleanest historical example we have is Argentina between 1998 and 2002. And I want to walk through what really happened there, because the truth is uglier than the doom prepper version and uglier than the optimist version as well. It was brutal across the board. So to set this up, through the 1990s, Argentina's peso was pegged at 1-to-1 with the US dollar. Most mortgages and bank deposits were dominated in US dollars. Government debt ballooned, investors lost confidence. By late 2001, the system was broken. Now, here's what actually happened. In December of 2001, the government froze all bank deposits. The people of Argentina woke up and discovered they could not access their own money. According to the American Enterprise Institute, the banking system lost about 20% of deposits during 2001 as people scrambled to pull out cash. Even those who had money in the bank could not get it out. In early 2002, the government did something called pacification. Dollar-dominated loans were converted to pesos at 1-to-1. Dollar-dominated bank deposits were converted at 1.4-to-1. The peso then devalued from 1-to-1 with the US dollar to be about 4-to-1 within 1 year. What happened to the broader economy was devastating. According to the data, Argentina's GDP contracted by roughly 28% from the peak of 1998 through to 2002. Unemployment hit 21 to 25% at its worst point in May of 2002. The poverty rate jumped from 38%, which is already high, to 52% in 6 months. Extreme poverty more than doubled, going from 8.3% to 18% in a single year, according to the World Bank. People lost their jobs, People lost their savings. Retirees on fixed pensions watched their purchasing power get cut in half. Small businesses that depended on dollar revenues collapsed. There were riots. The government fell. This wasn't a story of, oh, we need a reset to make things more affordable and then everything's going to be better after. No, this was a catastrophe. This was a national crisis, and it was horrible. But what we take away from it is that some people fared less badly than others. So inside this catastrophe, here's how different groups actually fared. The biggest losers were the savers and depositors. People who had spent decades building up bank balances watched the freeze on their money. They watched pacification convert the dollar deposits to an unfavorable rate, and then watched inflation erode whatever was left. Middle-class retirees were wiped out. Many never recovered from this. The second biggest losers were workers and the unemployed. With unemployment at 25% and the economy contracting nearly 30%, anyone dependent on a paycheck faced a real possibility of losing their income for years. Banks and bondholders also took massive losses. Banks were forced to convert assets and liabilities to different exchange rates, blowing huge holes in their balance sheets. Foreign bondholders eventually had to accept write-downs of more than 70% on debts. Now, here's who fared relatively better in certain scenarios. And it's homeowners who already outright owned their home. They fared the best because they had the house, they didn't have any debts on it, and they didn't lose the underlying value, even when the currency did. Real estate prices initially crashed in dollar terms, but stabilized and recovered over the following years. And homeowners with local currency mortgages who managed to keep their jobs saw their real debt burden cut by roughly 75% over the worst of the crisis. That's the wealth transfer that people talk about when they talk about these sort of resets. It happened, but the critical condition was they had to keep making their payments. The combination of mass unemployment and frozen banks meant a meaningful percentage of those winners lost their homes anyways because they couldn't service their debt and they couldn't service their mortgage in the short term. So the honest version of this story is, in a true debt crisis, almost everyone gets hurt. However, people that own real estate, and even those with mortgages and the ones who kept their income, got hurt less. And on the back end of this crisis, those who held on actually came out ahead in real terms. But the path to get there was brutal, and a lot of people didn't make it. Now, let's translate this to Canada. Honestly, we're not Argentina. Our institutions are stronger, our currency is not pegged, our debt, while larger, is overwhelmingly in Canadian dollars, which means we have more flexibility than emerging markets do. A 2002-style Argentina collapse is extremely unlikely here, but a softer, slower version of the same dynamic, that's much more plausible. Here's what a realistic Canadian debt stress scenario could look like over the next decade. First, you could see sustained inflation in the 4 to 6% range. Not hyperinflation, just structurally elevated. The Bank of Canada runs a softer monetary policy than the US Fed, and that makes debt servicing manageable. Another thing you could see is a weaker Canadian dollar relative to the US dollar, probably in the 70 to 75 cent range or lower. This makes everything imported, food, cars, electronics, fuel, more expensive in Canadian terms. Another thing would be a recession or sustained lower growth. Unemployment could realistically climb to 7, 8, 9, maybe even 10% in stress scenarios. Not Argentina levels of, 20 to 30%, but enough to put real pressure on households carrying debt. The other thing we would see is house prices could potentially flatten or fall off. You could see a house that's worth $800,000 become a house that's worth $600,000. But the one thing to keep in mind with this, that solely depends on if someone's selling a house. Right now, we have people trying to sell at higher prices and people don't want to pay them, so we're in a bit of a freeze. The only way we see the value of a house go down is if people start selling their houses at lower prices and accepting those lower prices. Right? We live in a society where the value of something is what someone is willing to pay, but also with what someone is willing to sell for. So the only way we would see prices be forced down would be by forced sales. So people who are being forced to sell their home because they can't afford the payments, because they've lost their job, because they're about to be foreclosed on, things like that. And then what we would finally see is mortgage holders quietly transferring wealth in their direction. Only the ones who keep their income, manage their other debts, and don't get forced to sell at the wrong moment. This is the real Canadian version. It's not an apocalypse. It's not doomsday. It's a grind. And the people who get hurt the worst are the ones who didn't plan for it. All right, this is where I'm going to give you something that most people don't really talk about. Forget the speculative scenario for a minute. Here's 3 defensive moves that you can make regardless of which way the economy plays out. 1, stress test your mortgage at higher rates and with lost income. Most people stress test by saying, oh, well, can I make my mortgage payment if rates go up? The better question is, can I make my payment if rates go up and one income disappears for 6 months? That's the real world stress test scenario. That's what matters. 2, understand the type of debts you're holding. Fixed Canadian dollar mortgage debt is fundamentally different than variable debt, US debt, and unsecured consumer debt. Fixed Canadian mortgage debt is the most protected from inflation. Variable and consumer debt are the most exposed. Knowing the mix you're currently carrying determines how valuable you are. And one thing to remember, the variable rate may be lower, but never take the variable rate because it's the lowest rate. Take it because it's going to build a strategy that helps you build wealth in your house and pay your mortgage off faster. And finally, number 3, stop optimizing for the wrong variables. Most homeowners optimize for the lowest rate today. Smart homeowners optimize for more flexible structure that lets them survive any environment. See, I'm tying it back to what I just said before. Sometimes that means paying a slightly higher rate for a fixed mortgage. Sometimes that means a different lender entirely, because we know that RBC, CIBC, and many other chartered banks have very, very unfavorable penalty structures that lock you in. Sometimes it means a smaller mortgage and a bigger emergency fund, or sometimes it can mean a larger mortgage and a bigger investment account that's earning positive rates of return that outpace the interest cost of your mortgage. The thing about this is that math doesn't care about headlines, and hope is not a strategy. The homeowners that navigated Argentina best weren't the ones who predicted a crisis. They were the ones that had it structured for their financing and their mortgage so they could survive multiple scenarios. So that's the honest what if. If a debt crisis hits Canada, almost everyone gets hurt in some degree. However, real estate holders or people that own a home and have borrowed a mortgage who have stable income are going to fare better than others and on the back end of that cycle, and may even actually come out ahead. But the people who really survive are the ones who built flexibility into their financial structure before they even knew they needed it. And if you want help mapping out which mortgage structure makes sense for you in your specific situation, there's a link in the description below. There's no pressure. It's just a free consultation call to provide some clarity. And if you're worried that you're in a stretched position, that a recession, a rate spike, or a loss of income could push you towards losing your house, the video on the screen is the one you're going to want to watch next. I break down the 5 exact moves you can make if you're facing that possibility of foreclosure here in Canada. My name is Myles Nowik. I own the Nowik Mortgage Team, powered by Andy Mortgage. And if you got value out of this video, maybe hit that like and subscribe button so I can keep growing the channel and so more people see it. And we'll catch you on the next one.